Greetings, Dr. Jeffrey Scott. This is my weekend market update for Sunday, August 11th, 2024. Sorry for the lateness as I've been traveling. I titled this Markets Rally Off Monday Crash Lows, or now will new highs or a retest come first? Again, my name is Jeffrey Scott. My email address is hgsidoc@gmail.com. If you're new to my channel, welcome. Please hit the subscribe button, hit the alarm so you'll get notified when I post these. And if you like what I'm doing, hit the up thumb. I've been doing these for a long time. I started doing this for a small group of friends, and I just posted it on YouTube. And yeah, I still have very modest people watching it, but I appreciate anybody that comes and takes a look. Not here to sell you anything. I do have some tools, and when I talk about the tools I use, it's just so people who have them can learn how to use them better. Um, all right. As always, this is for educational purposes only. Anything I talk about should be taken in the spirit of education and not investment advice. I'm a doctor, not a broker. I am independent. I have paid for all the tools that I used, and no one pays me or gives me product to say good things about them. Trading involves risk, and you alone are solely responsible for any investment decisions you make. If you like these videos and you want something more common or more frequently, but you actually want something shorter, join me at stocksanddocs.com, which is a website that's provided to me through the Wealth Charts family, where I post a daily video using wealth charts. Again, the purpose is so that folks see how my workflow is. So those that have bought wealth charts, especially those that have bought my tools, can see how I use wealth charts in my day-to-day trading. Major markets tell the story. So I think the most impressive column is the column price change since the beginning of the week. And why is it the most impressive? Because take a look at something like the S&P 500. It actually rallied 4% from the open on Monday. Okay, that's pretty impressive. How about Bitcoin rallied 22%? The Mag 7, 9%. What we saw, even ARC Innovation, 12%. So we saw a big gap down low Monday, a mini flash crash, perhaps related to concerns about the prior week's employment numbers, perhaps because of the concern that the Japanese would raise the rates, thus putting an end to the Japanese carry trade, which allowed you to take money at low rates and buy higher performing assets. Therefore, people might have had to reduce those assets. And then I wonder on Monday at the open, maybe 11 o'clock Eastern time, how much of what we saw were margin calls. So there was a lot that happened. In fact, if you actually look at the week, NYSE was up 0.6, the equal weights were up 0.6, the Qs were up 0.4, the spiders closed where they closed the prior week, no change. Equal weights were down 0.1, the Mag 7 was down 0.2, the Nasdaq was down 0.2, the Dow was down 0.5, and the small cap Russell, which is going to be the most volatile typically, was down 1.2%. Who would have thought Monday after the open that we'd end up with a relatively flat week? What I like to point out is even though we hear how the underperformance of the equal weights on the Qs and the spiders, when you look at where they've come from the late October lows, we've had a massive bull market and a more broad base than just the Mag 7, Mag 8, whatever we want to call it. When we look at the spider ETFs, you could see similar big moves from the beginning of the week and relative flatness with nothing more than 1 or less than 1%. In fact, materials were the only thing down in the S&P 500 on 5 days and discretionary at 1%. So 1.3 over 5 days for the industrials, 1.1 over 5 days for energy. So relatively flat week on the sectors as well. The Q Edge tool is a tool that enables me to get a like a heads up performance of the market intraday after hours. And I really look at a couple of tools here. We're going to talk about buckets later, but this gives me a real-time buckets. And that's really important because at times of market extremes, I will get an intraday signal that says, boy, maybe it's a good time to come in or leave. If I have too many stocks below the Bollinger Bands, it's a good time to start thinking about buying. And if I have too many above the bands, it's a good time to think about selling. We always get a reversion to the mean. And then here I can see the number of sectors up, industries up, and stocks up. Again, that's real-time updated during the session. Why is that important? Because sometimes you're going to see the major indices down, yet the broad-based stocks are up, and that's not necessarily a very bearish picture. Other times the indices will look like they're up, and the broad-based indexes are down, and then this is on the S&P 1500, and that tells you something that, well, even though those mags are up, the rest of the market's being punished. This tells me down here over 1 month the market has been strong despite the recent weakness. It was so strong on Thursday that over the last 2 weeks, 2 days, the market was strong. And then Friday's picture was kind of mixed. So how do I put this all together? Short-term weakness, longer-term strength, and kind of a wait and see signal on Friday. This is the Q market breadth tool. This combines the NASDAQ and the NYSE into total view. And what I wanted to point out was a couple of things. We had a very hard sell-off here. Seasonally a little early. These magenta down lines are something that Ian Woodward invented decades ago called bingos. I've talked about the bangos, which is a sign of irrational exuberance. But the bingos are a sign of baby out with the bathwater. This little green candle here is a eureka. Now, again, this is on a synthetic composite index combining the two large NYSE and the NASDAQ. So you may or may not see them on the individuals, but a eureka after bingos to me is typically a buy signal. And you could see that we had 3 accumulation dots fall on Thursday. Very strong session. If you look at earlier, you can see what happened on Monday with the big gap down and the across the board distribution signal. So not a market without risk. All right. If I want to look at the NYSE and the NASDAQ, you could see a couple things on this chart I'm going to point out. The NASDAQ on the left and the NYSE are kind of lock, stop, and barrel here. Both look like they're bouncing. If this green line is a 13-week new high, new low, no surprise to me that we bounced when we bounced because we got to the point with pretty massively oversold conditions. If we look at broader indexes, you could see we're still oversold on the Dow, coming off oversold on the Russell. The NASDAQ 100 did so well so fast it's neutral, as is the 1500 and the S&P 500. So clear improvement in the market over the last several sessions. The question is, where do we go from here? This is the Nick Drendel tool. Like $50. It uses data that's free in Excel, and why not have this up on another machine? Because it tells you how your indexes are doing, how they compare to their moving averages, where your closing range is, the new highs, new lows, something that I find very important. And then he's taken his favorite 25 industry groups, most of these are growth related, and shows you how they're performing over various time frames. What does this tell me? It shows me that we had, at least in the major indexes, not the IWM, we had strength on, a little bit of strength on Friday, closed in the top of the range. It shows me here that we are not gangbusters above the moving averages. In fact, even ARKK is below the 200 SMA. So still a lot of damage was done. Down here, we're still seeing more new lows and new highs. And I don't think all-time highs are built upon new lows. So that's something we're going to have to watch. And if you look at Friday, and we certainly saw my weekend review of charts, cybersecurity is recent strength, probably ever since CrowdStrike's disaster. Software was up, and losers were solar and cannabis. Cannabis is so volatile. Over the 5 days, it was actually up. What were the big winners on the week? Cyber, software, defense and aerospace, semiconductors, and China. Now, I look at a number of things underneath the indexes to give me a sense of what's going on. One of the things I like to look at is interest rates. And what do I see here? I see that on the week, the 10-year and the 30-year were up. Now, interestingly, the S&P, was flat, so it didn't fall with the rising rates. I think sometimes rising rates are bad. Rising rates are bad when the Fed is clearly tightening. Rising rates are bad when they're rapid, as you could see with this rapid rise in rates, the market really fell off. But sometimes I get the feeling that rapid rising rates, like we saw on the end of the week, was because people felt the economy wasn't dying and that there still was activity. So it'll be interesting to see. I think the rate's coming down. I think we get a cut in September. Will we get 2 cuts or 50 basis points? Market thinks so. I don't know. I think that might still scare people. What does the Fed really know? What about that recession risk? I think we're going to be watching this thing here, the 10-2 yield curve. It's about to reinvert. I think during the day on Monday, it actually got above the zero line, and then as the markets recovered, it came down. Now, everybody's so hung up on this and a couple of other signals that are out there, and with the thoughts that, yeah, it's got to reinvert, go back above zero, and then we definitely have a recession. But you don't know when the recession's coming. As we see here, when it goes back above zero, you get the gray bar. The zero is the black line, but it can be delayed. So do I think we have a recession? Sure. But I look down here at the Philadelphia Diffusion Index of activity. We're still have a manufacturing is still working in this country. I look over here at the high yield option index, option adjusted spread from BOA and ICE. I don't see credit tightness, which I saw with every one of these recessions. And then we're nowhere close on the 10-3 months. So my guess, yes, recessions happen. We will have a recession. Maybe that recession occurs after the new president's inauguration. And, the funny thing is, I think back to, I remember very well the day that President Obama was inaugurated for his first term, and how hard the market sold off during his inauguration speech. And it turned out they did okay over his time in office. But I wouldn't be surprised, no matter who wins, if we see a pretty significant market sell-off after the election. That's as political as I'm going to get. Market breadth mixed on roller coaster week. Stocks above the 300, stocks above the 40 came down. 12-week new high, new low came off of lows. No signals here. Current buckets, 67% of the stocks in the S&P 1500 are trading below the midline of their Bollinger Band. It's pretty bearish, not excessively bearish, but hardly anybody is below the bands themselves. So no signal here, but a market that's currently under pressure for sure. Hindenburg omens, never good things. These are old wives' tales. You need 2 for them to be confirmed. No major market correction has ever occurred without these things firing. I probably talk too much about them, but they've done me well. And if we look, we could see that on Friday we confirmed Hindi NYSE, just the commons. We had a firing on the all Hindi, all NYSE. I pay less attention to the all NYSE because it includes a lot of things that may not be correlated. So I only really want to look at the common stocks. And then the NASDAQ has also in a confirmed Hindenburg. So why does that matter? Because when you see them, it's not necessarily a good time for the stock market. It's sort of the pros dumping their stocks to the amateurs. Now, I don't usually put in this slide, but I couldn't resist. This is from Hindenburg Omen Quant Nomad. And this is something on TradingView that's free. And I just thought it was impressive how you look back at the last 3 or 4 market tops. This one called every one of them. And look at this. It's calling one again. Now recognizing, let me see if I can do this. See if I can pull that up on TradingView. Just so you see the dates. Current, 2022, 2020, and this was in 18 at the end of the year. It's been pretty accurate, in my opinion. Why is that doing that to me? Hold on 1 second. I know why, because I had that thing engaged. All right, so that worries me a little bit. Markets had a wild week and recaptured much of the losses from Monday open, but it wasn't everybody doing well. It was actually an interesting week where most of the stocks were down, but it was some of these things up at the end, the mags, that were potentially higher. You could see the higher the earnings, the better the performance. The better the relative strength, the better the performance. Although overall the market was down, stocks with high relative strength outperformed. Know your news and earnings. Busy week. I just went the real hot ones. The PPIs, the CPIs, the jobless claims. We got consumer sentiment. We got housing starts, import prices, capacity. No question that we are in Fed trying to figure it out mode, and they're going to be looking at every piece of data. And then on the earnings, although some of the big cap names are done, many of them, there's still a big earnings week. And as I say in the lower right-hand corner, and heed this because to me it's very true, it's a judgment call to hold stocks over earnings dates. It is bad judgment to not know when your stock's earnings date is scheduled. So we survived the quick sell-off. Down Monday, finished the week relatively flat. Market timing model moving towards neutral, but still we'll look at it, still worrisome. Big slate of news for bulls. We're waiting on a follow-through day. NASDAQ or NYSE up more than 1% on a big volume day. That's what I'm looking for to think it's all clear. Although I did start some small starter positions because you could get things like NVIDIA and others really cheap on Monday. The odds of a 50% rate cut are increased. Bulls apparently like that. And August 22nd and 24th, so just really less than 2 weeks from now, we got the Jackson Hole meeting for economic policy, which is entitled this year, Reassessing the Effectiveness and Transmission of Monetary Policy. I think people will be listening to that. For the bears, it could be a bear flag across these major indices, which is prone to failure. We have resistance above. We got those Hindi signals. We got news risk. Markets don't always rally after the first rate cut. Plus, we have a yield curve about to revert to normal, which might lead to more recession concerns, further pressuring the market. So I'm cautious. I've raised cash, and I've got positions that are both long and short, but they are small and they are on a tight leash. This is old, but I like to put this up to remind me of 2 very important things that are going on right now. One, the blue lines are the market bottoms. The black line is the Fed rate. Notice, this one, the Fed rate had already come down some before the market bottomed. Back here, the Fed rate had been coming down before the market bottomed. Same thing here. This one was early on in the cuts, later in the cuts. Bottoms don't occur the day before they cut. Bottoms can occur sometime after. And then the red versus the black, or the black circle versus the red here, it shows you the difference of what happens to a bear market during a recession, averaging over 30% down versus closer to 20% in a stronger secular market. We don't want a recession. Again, I do these daily, less of PowerPoints and just go into the charts. Again, appreciate you being here. Now let's go into that aforementioned charts. I'm going to use predominantly wealth charts today. Wealth charts, in my opinion, as an inclusive, all-in-one program, which if you are buy it at the best time to buy it, which is at the Wealth 365 events, costs less than $1,000 per year, including futures data at $6 a month. So that puts it maybe 1040 because it's that wasn't included in the usual price. It is a incredibly full-featured program, and it comes with a host of educators, including Rob Hoffman, Ziad, and others. Um, I get to speak from time to time at the Wealth 365s. I'd probably do a lot more during the market week if I didn't have a full-time job. So I use this because it's got a large um, base of users that's growing, and I want you to see workflow. Whether you follow how I do things or agree with what I say or not, I don't, it's a free world. But what I'm trying to show you a workflow solution for this really powerful program. So I have a weekly timing model. It consists of two things, a 30-period WA and MA in white and a bongo, which is my trending indicator at the bottom. To turn into a buy, the bongo has to turn green and I got a cross above the WMA. To turn into a sell, I've got a cross below the WMA and the bongo has to turn red. Right now, the spiders weekly, if you look over to the data window, you can see the spider weekly closed at 532.99 and the WMA is at 531.17. We remain close to a sell on the spiders, but we're not there yet. We are in a sell on the Qs. We are close to a sell on the diamonds, WMA 334, the close 337, and we are actually still in buy signals from this prior green bongo on both the diamonds and the IWM. But with the red bongos, all it's going to take is a close below the WMA and the weekly, and they'd be in a sell mode. So I'm going to take this caution guy and I'm going to move it over here because we are in caution here, and something that I'm going to pay attention to. So how do I put this together? It's, and has this helped me in the past? Yes, it's helped me in the past a lot. And how I put it together is it gives me a sense of how aggressive I want to be in the market. And right now, I don't want to be in the market very aggressive. Why? Because I'm at a yield sign on these three. I have to go and create it, so I haven't yet. I'll just take this one and change it to a yield sign. So I'm in a yield sign on 3. I'm in a sell on the 4th. That is not a market that tells me buy, 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 buy. I was so impressed by what we saw, well, I'll play with this later, with the recent rally that I did make those small purchases. But I kid you not, small purchases, tight stops, both long and shorts, and tight leash. So this is not a strong market. This is a market that is at risk of even the two things that are long, and frank, this one also long. Each of these are at risk of reverting to the other direction. So I think the market has risk. The daily market timing model, which is short term, is in a sell across the board. Something else that I pointed out the last several sessions is you got to look at seasonality sometimes. And I'm not going to pay much attention to this part because I got the date up to where we are, August 11th. Okay. Now they're both sitting on the same. Move this to September 18th, which would be option expiration. And if I look here at, just pick a couple things, and I may need to type them in because there's not bullish seasonality on the major indexes here. Let's go over here and go to bearish. Let's look at the spider. The spider between over the 14th, which is Wednesday, and then options expiration in September, is down 6 out of 10 years, average performance minus 1.2. I mentioned before, did it come early? This is a seasonality line that shows projected. Maybe it came early and we start to get the year-end rally sooner. I don't think so, but it could be. The Qs actually up 7 out of 10 years over the next month, but average return is negative because of this. Did it come early this year? Maybe. And then the Russell, similar pattern here of upcoming weakness. Now, the diamonds didn't make the chart, which means it probably doesn't have a seasonal signal as much. And let's just look at the diamonds here and see the chart. And the diamonds as well gets into a rougher patch. So I look at it and I have my timing model isn't sell, sell, sell. It shows risk. And the seasonality is bad. I think you got to look at those things. All right, let's go look at some charts. Let's start with the 5-minute chart on the spider. And what a week. Yep, I got my days right. Friday, Thursday, Wednesday, Tuesday, Monday. Yes. So Monday, what a start to the markets. Just a massive sell-off at the open. But even on the first bar was an indecision day and it was green. And the second bar was a big move up. And then the market flirted with resistance here, broke above, and closed midway in its range. Tuesday, we was a rally session until the end when we sold off. Wednesday, gapped up and came down. Thursday was a negative day, and Friday undid Thursday. Talk about a roller coaster week. Now that's the spider. If you want to look at the other components, you could see they kind of maybe accentuated it, but you had a similar pattern across the board with the massive sell-off on everything on Monday. If I look at the daily spider, you can see here was Monday, a close much higher than the open, but boy, we still had a bunch of activity that we couldn't hold on to. Tuesday, up day, and again, you have these topping tails, which are worrisome, right into resistance. Wednesday and Thursday, we broke above resistance, and now we're going to have to get beyond the 50-day moving average. So there's lots of resistance overhead. You look at the performance on Friday, up 0.44. Is this a bear flag? Wedge? Could be. So I'm watching the 50 on the upside. I'm watching the 200 below, but we're starting to put some resistance areas underneath us, or support areas, which is good. If I look at the Qs, we're going to see a very similar pattern. The Qs moving up right into resistance in between the 200 and the 50 after significant sell-off. Qs were up 0.52 on Friday. The diamonds. Now, diamonds look different. The diamonds really never had as much of a break as the others. And it's already trading above its 50, which I like to see. Nice moving action after the pullback. But again, is this another bear flag? And I'm being tolerant and lenient in what I'm describing as a bear flag. But whether it's a wedge, whether it's a flag, it's not a bullish pattern. Here is the Russell, and you could see the Russell had a tough day the prior Friday, and then gapped down almost down to that 200. Actually did trade down to that 200 line, and then it's done the same thing, failing at the 50, and was down a little bit, 0.21 on Friday. If we look at the VIX, let's look at just a daily VIX. You could see, and let's put on a data window. You could see we had a high of 65. George Lee, may rest in peace, good friend, great trader, awesome teacher, used to say, when the VIX is high, it's time to buy. When the VIX is low, look out below. Well, we've been waiting for that spike in the VIX. Is that a signal to jump into the market? Well, the market's rallied as the VIX has sold off, but I still think there's risk in this market. You can look at the weekly VIX and see that spike. Dollar, yes, it's up a little bit off and on the last couple of sessions off the lows, and this was the Monday low, but we're still kind of where we've been for a while, consolidating well off of its highs. If I look at commodities, dollar is down. You'd expect gold and silver to be up. Didn't do much, up 0.25 on gold. Silver is more of an industrial metal as well, and this one was down. Look at the difference. Gold looks like it wants to go higher. Silver is a lot less impressive. Oil was up. You'd think it was up higher with what's going on in the Mideast. Um, It'd be interesting to see what happens with oil. You could see the 10-year, and I'm now using a built-in symbol inside of well charts. And you could see the 10-year cratered on Monday. That wasn't a strong day. Sometimes a low 10-year is a sign of problems. And moved up, but still well off its highs. If I go and I look at breadth, I like to look at a couple things. TLT versus the spider. Is this breaking out? Not really. Why do I look at it? Because let's go to a monthly chart. And let's give me some more data. All right, we're going back to 2003. What happened here in 2008? Big recession. What happened in 11-12? We had the temper tantrums. What happened in 2020? During periods of disruption in the U.S. economy, this thing will spike. It hasn't spiked. Now, it will spike at some point, so I think it's worth taking a look at. Another thing is credit risk, and I'm looking at the IEI versus the HYG, and I'm looking at a ratio chart, just like the other one was. And what do I see here? I see 2020, we had a big spike. We've come up off the lows, and that might be something to watch, but it's not showing me trouble yet, especially when it came down on Friday. I like looking at the equal weight spider versus the cap weighted SPY. I like the equal weight QQE versus the Qs. We're well off the bottom. When we're heading north, it tells me the equal weights are performing. Didn't do so much the last couple days. So I learn a lot from ratio charts. Then I like to use ratio charts to look at the various sector ETFs versus the spider, and I'm looking for a couple of things. The big winner is going to be sitting up in the upper right-hand corner. Now, who's the big winner for this week? Communications. What are the big components of communications? Meta and Google. So I might want to look at communications. So they get a star. Why do I put the star here? Because next week, when I get to the end of the week, I'm going to be able to I only want one star. This one I want to kill. I'll be able to look at it and say, oh yeah, over the weekend, this was the best performer. Now, last week it was staples. They've come down some. That's probably a good thing. Real estate came down a little bit. I still think real estate's going to be strong. And when I say a little bit, I'm not kidding. Utilities also defensive, eased a little bit, as did healthcare. Still strong, just not the one in the pole position. What's weak? Well, what's weak is discretionary, and technology is still weak on the longer period of time, although it showed a little bit of strength on Friday. In the scanners, I like to start with the heat map. It's a great opportunity just to look at some of the mags. I mentioned communications is strong. Meta looks interesting here. Obviously, if this market sells off, these are great places to cash in to get money to pay for your margin calls. Widely held and at high value cost, and a lot of people made some money on them. We've got this area in here that from this big gap up, and I wouldn't want to see it fill that gap. That's a huge way. Right now, it's got a wealth signal. It's got an EMS signal. It had two dots on Thursday, breakout momentum coming out of a squeeze. Relative strength of OBV looked good, not extended. If this market rallies, it would not surprise me if Netflix is one of, excuse me, if Meta is one of the leaders. I said Netflix. Well, I'm going to look at Netflix too. So let's look at Netflix. Netflix has pulled back and is starting to rally. I like buying things above the 50, so I'm going to watch this closely and see if it can get back above the 50, but I could see people buying it now. Apple got above the 50, like that. Nvidia, not yet above the 50, is going to have to break this line. They've failed at it multiple times. Tesla has sold off some well below the, not well, but it's below the 200. SMCI, not a Mag 7, Mag 8, but another sign of AI. And this one sold off on earnings, not because their earnings were bad. Their earnings, well, they did miss, but their problem was not orders, it was supply. Microsoft, look at that. Maybe it's a good time to buy Microsoft. You don't get a lot of opportunities to buy it off the 200. The last time we had that was in March of 2023. But, it's got a lot of overhead supply and resistance to go through. Amazon looks like Microsoft. AMD bouncing around long-term support there. So not healthy, except for maybe the leader is probably Meta. If I look at the S&P 500, there's a fair amount of green here, and the big leader here is Lilly, which had just blockbuster earnings, and you can see here 45% beat on a massive company. I wonder when they're going to do their 10 to 1 split like everybody else seems to be doing. Hasn't worked out great for Nvidia, which certainly was predictable based upon others that have done this in the past. So um, gives me some sense of what's going on. Then I like to look at Wealth Scanner. Now, just for a quick side note, there are thousands, probably are thousands of indicators available inside or in wealth charts. I use and scanners. I use the things that I like to use on a daily basis. There are things that I'm not showing you that I use just because of time constraints, and I could confuse you enough with everything that I do already. But this is my daily workflow that I do. Next, I want to look at in the wealth scanner, I created a basket of ETFs, industry, indexes, sectors, themes, to give me a sense of what's working. Now, I know that the highest I can be is 850, and sometimes everything is an 800. There is no breadth of strength in this market right now. Nothing's above 800, and I'm dropping down to 400. Now, I could flip this and look at the bearish. Let's flip it around here. And interestingly, global MLPs, which have been strong, actually sold off big interest payers. Oops, you just did that to me. Clean power, gas exploration, oil, so some transports. This just tells you intelligent infrastructure, tells you where some of the weakness has been. But I'm still going to stick to the upside, and I'm impressed by the lack of 800s. So let's just look at what's up here. Real estate, real estate, real estate, real estate, dividend payers, real estate, and now we're below 700. Seems to me that strength in this market remains real estate. Now, my CAT scanner allows me to look at the market as a whole, but let's just start with real estate and see if there's anything that's actionable. And I'm looking for pullbacks and uptrends, which is my favorite things to buy. So, don't know who these guys are. Kennedy Wilson Holdings. Do they pay a dividend or anything like that? But here's a nice little uptrend that's emerged in a squeeze with volume, breakout, and momentum. Not extended, strong relative strength in OBV, and the earnings were, well, it looks like it's a negative, but it was a 12% beat. less of a loss than expected. So it's really a substantial good story breaking above the 200. Now, this has been in a longer term sell off. It's a smaller capitalization play, but that doesn't look bad to me. CTRE, Care Trust, is one that's looked good for some time. You can see it's in a nice uptrend. Why did this show up on my scanner? Because it pulled back and it's moving higher here. Lots of volume coming in, which you like to see. Equity retail. You know, Simon Properties, equity retail are all things that people might be afraid of because we listen to CNBC and we hear that all the office centers are open and the malls are dead, yet their ETFs have done well. So this is in a nice uptrend, recent pullback in here. EDR, nice uptrend, pull back to the 50, breaking out here. So this allowed me, let's see what Invitation Homes looks like, to find, it's kind of, I don't like when they're sideways. So allows me to find stocks for the most part in uptrends, and even this is in an uptrend on the weekly, that have pulled back towards a support and then have gotten some breakout from momentum. Now I could look at anything that's got momentum signals and see if anything else comes to the top, and not really. Here's Simon Properties. Big uptrend, sideways move, breaking out here from a squeeze, relative strength OBV. you know, they this is one of the leading groups, and they look okay. All right. Um, what I usually do is I'll go to my combo group, which I typically include in the remarks section below for Wealth Charts users, and it's about 1,000 my top 1,000 stocks over the weekend, and I look at 1,000 charts plus every weekend. And I don't like to buy. It's funny, I call these rockets. This thing is getting extended, although it's not too extended. Let's see if there's anything that looks extended up here. Oh, come on now. Well, I guess with the sell-off, I'm not seeing extended. These are going to be on the pullback scan as well. But sometimes you'll get something that's so extended you can't buy it. I like buying pullbacks. And pullbacks in an uptrend. So here is a list of stocks by how many of my momentum signals they had. Akamai, short-term uptrend, pullback below the 200, no interest. Car Gurus, I don't understand the used car market. Um, and I talked to somebody who is an expert. He's talked about how prices have come down, but Car Gurus had a big gap up, pullback. Here's your uptrend, big pullback, and a massive gap up and breakout. Must have been on earnings on Friday or Thursday night, and 24% beat. I'd have to do some more research on it. It's not extended. Look at relative strength and OBV. Evolent Health must have had an earnings beat, 16% beat. Actually, it's one of my customers. Not exactly an uptrend over a longer period of time, short-term uptrend. These big gap moves that I see on earnings have a tendency to trail back and flag before going higher, so I might look for that. Expedia, no. See if anything. AGRO, again, below the 200. The trade desk, uptrend, pullback, breakout on earnings, 11% beat. I liked the beat. I like the picture here. And I guess I have to give some consideration to the market because the market sold off so hard. But boy, you're buying something that it's rapidly moved up from the 200. Believe it or not, it's not extended yet, and relative strength and OBV look good. Those are some of the ones that came to the top in my list. Now, let me go to my buys list, and these are not all actionable right now, okay? These are stocks that I'm going to be watching closer for whatever reason. We already looked at Apple. ADMA Biologics, I've talked about it a lot. Hopefully you have a position in it. Had a big gap up on massive beat in earnings, 62%. I looked at the fundamentals going out. This one to me could go up, could still keep going higher. This was a great buying opportunity. And even though it keeps looking too expensive, it keeps going higher. Um, ALDX is another biotech. And these biotechs are risky, but sometimes they get great moves. You could see the risk, a big sell-off, cheap stock, breaking out here with a well signal and an EMS, big volume coming in. I don't think or it's about earnings, although it was flat, if I believe that. I think it actually did beat. Lots of green dots coming in. Now, it says it's extended. I don't consider this extended. Why? Because all these moving averages have been so tight. Any move is going to look extended the way I calculate extended. It certainly doesn't look extended there. Aristo Networks is a great long-term play, broke out of the flag. I like to see it show some momentum and volume, so maybe not yet. Abercrombie and Fitch, it's going to have some earnings coming in. This was such a great leader. Look at that weekly. Pull back to the 200s, moving higher. It looks interesting here, but earnings are coming. If you don't have a goal position, AU is a fresh breakout. Nice uptrend, pullback, and breaking out here. AstraZeneca, I talked about it several times on my stocks and docs. This is the current leader, in my opinion, in cancer therapy in the U.S. or new drugs, protected drugs. BMS and Merck have been the leaders for the last decade, but they got a problem. And their problem is they're going to have some problems with their PD-1s, their Opdivo and Keytruda and patent life and pricing and the IRA. AstraZeneca looks like a fresh breakout opportunity there. Birkenstock, a recent IPO, uptrend pullback, breaking out here. CMG, not cheap by any means, but a lot cheaper than it used to be. Probably more of a watch to me than a buy. We'll see what it does. Costco, fundamentally, this thing seems overpriced to me. It's multiple, maybe in the 50 range. Its growth rate much lower. But if you buy charts based on technicals, here is a uptrend pullback, a breakout above the 50, breakout momentum dot, not extended. Relative strength and OBV look good. Costco looks really good here. Semaphore had decent earnings. Still low in the pattern, but one where fundamentals get really strong going forward. Had almost a 9% beat. CyberArk is one that probably benefits from the CrowdStrike, and it and Palo Alto Network were two of the ones that I liked in this group. Kava is a IPO that got hammered on, I believe it was earnings up here. But Kava had a nice breakout on Friday. Breakout volume and momentum from a squeeze with relative strength and OBV look good. Again, an IPO. Make My Trip in Indian travel just keeps going higher. Buying it on pullbacks has been good. We mentioned Lilly. You look at Lilly and everybody wants to say best stock right now in the market, and it probably is one of the best stocks in the market. NVO has been weak because it seems to take the competition worries a little bit stronger, and its earnings missed, not because they don't have sales, but because they had supply issues. Those supply issues are resolving. So I think this one still, NVO still looks good. I mentioned Palo Alto, and I think we looked at it already. Palantir, everybody loves this stock. I've loved this stock for years. Well, maybe they're about to be rewarded. Kind of a cup, a handle, and a breakout. Just ignore Monday's action. But it had good earnings, 12% beat on earnings, and a lot of interest in that stock, fairly wildly held. And Under Armour has been dead for a long time. And it had an earnings surprise here where it was profitable instead of losing 8 cents. A big gap up here and went higher on Friday. Look at those dots coming out of a squeeze. Look at the relative strength at OBV. So that's just a journey through some of the stocks that I'm looking at. What is my workflow? My workflow, first thing I always do, only on Friday and the weekend, is look at the weekly timing model. And this tells me it's confused. There's no strong buy signal, no strong sell signal. Be careful. That's why you have those caution signals. I like to look at the indices every day and get a sense of where we are support and resistance. Right now, we're in between support and resistance, and I think the momentum is higher, but I think every one of these is going to run into resistance, and we're going to see how it plays. I looked at the sectors to see what's working, and the communications didn't show up at the top, broad based, but I think Meta still looks really good. I should look at Google. I think I forgot to look at that, so let's go look at that very quickly, or I will in a second. And then once I've looked at that, I'll go into the scanners. I look at the heat maps because it gives me a sense of what's going on more broadly. I look at the wealth scanner to see what's working now, and then I go into my CAT scanner to see if I can't find pullbacks and uptrends, which is what I like to buy and kind of what I've been doing for 30 years. And Google doesn't look like a big buy yet off the bottom. So the leader in communications is clearly Meta. So we looked at seasonality, and I showed you where it's tough over the next month or so. Lots of things going on, and I'll go back to where I talked about in the slides before I say goodbye. There's something to like for the bulls. There's something to like for the bears. I'm taking a caution stance, raise cash, smaller positions. I've entered some long and short. I hope you have an awesome week in the market. Please hit the like, subscribe, check out stocksanddocs.com, and I'll see you next week.